Section 41 of the tax code reads as the credit for increasing research activities is a permanent part of the tax code as of 2015. So with that in mind, it's essentially asking, hey, are you doing this kind of work? Do you qualify? Great. And then year over year, you can increase that credit. So I've worked with very small companies, whether they're cannabis or not, and maybe they get a $10,000 credit. That company, it's a bit of a lifeline for them because that $10,000 now allows them to maybe purchase that piece of equipment that they want to explore that new process with, right? But then the next year, now that they implemented that, now suddenly they're growing, they're scaling, the credit is going to increase because now we're investing more and more. And so I've worked with companies who started small and now they're really big. And we have been on that, train with them.
Hey, everybody. Welcome back to another episode of the Cannabis Accounting Podcast. Today, I have with me Kevin Culver, heads up the tax incentive side of the boutique tax consulting firm named Royce Partners. Tax attorney by trade, so comes to us from the legal perspective. Kevin, for those who don't know you, do you want to introduce yourself?
Yeah, absolutely. Great. Thank you for having me on. Again, I've been in this space. When I say this space, we call it the tax incentive space, right? There's a host of tax credits and tax strategies that exist out in the marketplace. And I like to think of myself as a specialist in one particular. Granted, I have a lot of familiarity with others, but the R&D, research and development tax credit is where I live the most, so to speak. But I've been in the space for nearly a decade at this point, from the audit side to all the way, from the smallest clients to the largest clients, making sure they're getting their R&D tax credit claims the way they deserve and the way they're entitled to.
Nice, nice. And then yeah, like we were talking a bit before, like I always enjoy bringing on guests who have they had a life before the cannabis industry or a profession because, every year for sure the cannabis industry becomes more like a traditional industry than less like a traditional industry. So we're
Yeah.
like trending towards this way. So tell us a little bit about what you did before the cannabis industry and then how'd you find your way into the serving your first cannabis client?
Yeah, no, I think it's a great question because my journey is a little bit unique. I mean, let's take it all the way back. My first job was valeting cars. Oh, I'm kidding. I'm not gonna go too far back. After I wrapped up law school, I worked for a very large, Fortune 100 company, completely really outside of this world, of this space, if you will. But from a resume standpoint, it was great, right, to get exposed to what it looks like at level when you're talking about quarterly financials. And I worked in the contracts department. That gave me a lot of understanding of different marketplaces, different states, and different rules. It was in the healthcare space, to be clear. So you're going to have different
Okay.
sets of rules with Medicaid, care, rural hospitals, non-rural hospitals. So there's just such a mix and hodgepodge. And then about after 2 years, that was over in Washington, D.C. After about 2 years there, the best part about working for large companies like that is it's a good resume boost. So certain offers are coming my way. And there was one in particular that really caught my interest. And that one had to do with if it was in tax space. And that's because in law school, in fact, I took a tax course, which wasn't elective. So you can already kind of maybe a masochist, I don't know. But it was interesting because I'd enjoyed so much about it was those of you that aren't lawyers, you have a lot of rules in place. You think about things like negligence and car accidents, and these things have more or less strict rules. Like, hey, did it cross that threshold of negligence? Did it meet that non-reasonable person standard? This is all fine. To me,
Mhm.
I got kind of bored because it's just too rinse and repeat. And when it comes to tax, we've seen, and you as a CPA, inherent background, even thinking this year's the legislative bill that passed in July, and then 2 years before that, you had the Inflation Reduction Act. We're talking about a whole new tax landscape, potentially every 2 years, every 4 years, which that means I have to get re-educated, re-understand the implications. Where are my clients at? And I like that because it's I'm forever a student, right?
Yeah.
And that to me is what always intrigued me. So when I got into the tax space, that's really what I started to go down that kind of rabbit hole. Really, my feet under me, spearheaded a lot of initiatives at the firm I was at. And that led to some other opportunities. And then ultimately, I opened up my own firm because I identified a particular need in the space that was underserved, right? If you're working for a large firm, the goal is, in general, a large client, right? It's a large invoice. You got more overhead. That's okay.
Yep,
But
yep.
that often means that a lot of small and medium-sized companies are often ignored, and that can be whether it's
Yeah.
geographical in nature or it's just an industry that's just not thought of in that way. And this thought process, because my college background was in New Mexico, and at the time, New Mexico just went recreational. It was the same year I started my company, and I really identified a market niche and a need for this kind of knowledge and this understanding of this complicated minefield to help these companies that are already going to be on tight margins, just to be clear, with their effective tax rates. Can I alleviate that burden with the knowledge that I learned up to that point?
Mm.
And then one thing led to another. Royce and partners and I together, and we all had a collective vision, and we are where we are now. And so that's what we've been doing.
Nice. That is interesting. And yeah, we met at MJ BizCon. That's when you came on my radar. Kind of you were
Mhm.
talking about just kind of the potential of like life after 280E and what that means. And you were on stage, yeah, with Viridian Capital and Chicago
Yep.
Atlantic and just kind of some very impactful players in the cannabis industry. Obviously, like Capital is big. Right behind Capital is cash flow, and R&D has like real tax cash flow
Yeah.
implications. And so I guess just to get into it right away, I feel like everybody always talks about 280E. The basic understanding is that if you're trafficking a Schedule One substance, no deductions, no credit
Yeah.
for your tax return at least the federal level, and then many states.
Right.
Obviously, there's states that have decoupled, but at a high level, no deductions, no credit. So I guess like from your perspective, why do you feel comfortable with cannabis companies taking the R&D credit? And obviously, like there's like the CPA's perspective, but then there's always the legal perspective. And as a business owner, I'm just trying to run a profitable business and retain as much cash flow as possible. So I guess,
Sure.
can you speak a little bit about the two camps of thoughts about the R&D credit and what makes it, why cannabis companies can take it or why people are afraid to take it?
Yeah. No, great question. So if I monologue here, by all means, feel free to interject. It's certainly broad, right? But let's kind of just open it up in that kind of same vein. We're thinking about a level of risk tolerance here, right? Think about it almost on a sliding scale. And some companies and owners of those companies, partners, what have you, they're going to have their risk tolerance levels be where they may, and that's their business preference to just operate in, and that's okay. First and foremost, I think what often gets overlooked is 280E is a federal rule, and all these companies have to file a federal tax bill. However, they also have to file a state tax bill. California is notorious for this. They aren't particularly cheap to operate in. I'm sure a lot of cultivators can give some truth to that. But nonetheless, when it comes to the state level, let's just go back to the classical constitutional arguments, right? The 10th Amendment says, hey, we're talking about states can reserve the right to enact their own rules and laws within respect to the bounds of their state. And often, and in particular California, I'll just use them as the poster child here, is, hey, look, through this recreational enactment, we are also going to decouple you from 280E. And decoupling is just a legal term. You already said it earlier, but just a legal term for saying, hey, look, we don't follow those rules on the federal level.
Yep.
So, for all intents and purposes, you're no different than the mom and pop shop down the street, which really means you get entitled to the same benefits that those companies, those businesses would. And that is what? Deductions, credits if they're available, so on and so forth. So, California also has a very lucrative R&D tax credit program that you can take advantage of, and maybe we can take Silicon Valley for lobbying for that. They certainly want to
Big time.
maintain their tech and their Silicon Valley space and offsetting any tax liability where they can. But in essence, the cannabis space is really young, right? It's just true.
Oh
It's just a
yeah,
very
yeah.
young space. So there's
Very, very.
constant innovation happening in this space. It's never a question of qualification. It's a question of how much. But the state
Huh.
level,
Yeah.
we think about it from a look, this company is operating within, again, we use California as that example, that is decoupled from 280E. So why not go after their R&D credits at the state level? And wherever we can open up capital, in this case in California, through that tax credit program, that's going to free up capital that they can use elsewhere. Maybe that's offsetting some of their federal tax bill, which really means they're paying full blown be hitting a federal tax bill, but now they have some more extra cash on hand that they can put toward that, and that frees up cash flow to go elsewhere. So that's where the comfort level lives. Right? It's blatant that
Right, right.
these
So
states are
just so I
decoupled.
understood, it's not like the federal level still has 280E, but then states can decouple. California is one of those states that have decoupled, and I haven't looked at it recently, but many
Sure.
states have decoupled from 280 because the state and local tax, like they have their own, clause in there that
Right.
they like are going to get their tax regardless, and so
Sure.
that's why I
Like
think they.
excise tax. Yeah.
Yeah, sales tax, excise tax, everybody like heard about what's going on in Michigan, where it's
Yeah.
like that wasn't the federal government handing down a 24% tax. That was the state and local that were like handled there. And as you
Mhm.
kind of alluded to, and I've learned this over the years, where it's like the states aren't your friends. Like, yes, even they may have legalized medical or adult use, but they're
Sure.
going to be some of the most like, greedy tax codes out there. And so and I get it. It's almost like a bribe. It's like, all right, we got to pay the state their
Yeah.
tax, then there's the local tax, then there's the local municipality improvement tax, then there's like the local fire chief you got to
Yeah.
make happy. I'm like, this is like
So
kind of
many
getting.
line items. Yeah. It's
Yeah,
tough.
yeah. So that was kind of like a question I had then. So yeah, so then the states decouple, in which case, hey, you guys can operate as a normal business as far as 280E is concerned. You still got to run a profitable, cannabis
Yeah.
cultivation or manufacturing business, but you're allowed to take deductions and credits. So I guess what are some common R&D activities for these, whether we'll use the big three, like cultivation, product manufacturing, and retail. Like, what are some common R&D? Because we have a client, for example, that's made a new line of gummies. And so like there was
Sure.
would allocate some, medicated material, bring in a bunch of other material to kind of like test out the product, get to a prototype that's usable. Like there's tens of thousands of dollars. So it's like,
Yeah.
what are some expenses though that you kind of like see that are common for our audience?
I mean, you just described a perfect example of how you developed new gummies that led to the prototype work. They had to kind of do some market testing on to see if it met certain what parameters that they were seeking to meet, right?
Yeah, get the
But
right hitters.
when it comes to thinking about vertical integration, which is what we commonly see in this space, I think it's just the nature of how it operates right now because of how 280E works at the federal level. It's a little bit safer to run it vertically integrated, as in cultivator processing and retail all the way down.
Mhm.
But you can think about R&D as new strain development, process improvements. Suddenly I'm improving my manufacturing process where I was only able to produce X amount of pounds, in a given grow cycle, but now I can do this much more because we developed a new method of achieving that. Right? I'm speaking very broadly because this is going to be different by every company. And what's
Oh
really
yeah,
important,
yeah.
yeah,
Huh.
yeah, it's a fascinating thing because back I mean, R&D credit's been around since 1981. Right? This was an incentive through the Reagan administration that said, look, we want to bring domestic manufacturing back because a lot of overseas manufacturing occurred. So they said, look, let's reward companies that are doing U.S. development, innovative work. From the beginning, it was really for practical work, right, new to the world. But that's really restrictive because that's really going to mean you got your pharmaceuticals, you got your big, Fortune 100, top 10 companies who are really taking the bulk of that. I mean, think of Raytheon, Lockheed. They're going to eat up some huge R&D credits. And not to even mention tech. But then as, time progressed, what became abundantly clear was, a lot of companies are innovating, right? You can think of a small software company that explodes. You think of your Silicon Valley is a great example of this. They weren't Google wasn't around in 1980. And so what happens is in 2004, I think it was an excellent decision that was made, but there was a Treasury directive, and they said, look, the work that's being done does not need to be new to the world. It just needs to be new to the business, right? So if you're doing an R&D activity and developing a new process, a new
Yeah.
prototype, then that is qualification so long as it meets the parameters of R&D, and we can certainly touch on that as needed. But think about it from the economic boost, if you will, right? Because if I'm a medium-sized business, a small-sized business, let's just use Kevin and Ray here as a perfect example. Kevin, I developed a process where my output of new strains and new products are now exceeding yours because I developed a new process mechanism in the manufacturing system, right? And you
What
go, oh
about
man,
what
sorry, go
about
on.
like just like trying to pheno hunt like new genetics and whatnot? Like I feel like that's kind of like how we think about it. It's like, yeah, we're researching and trying to find new strains, and if we combine these two, so it's like there's whole rooms kind of dedicated to the pheno hunting, which I kind of think is R&D. And it's like we have
Yeah,
electricity going into those rooms, we have overhead going into those rooms, we have staff labor going into those rooms.
yes.
Is that stuff, would that all be R&D kind of from like the cultivation perspective?
Yes, absolutely. It falls into the category of R&D, but what categories of expenses can you capture toward that effort is, a layered question. So we'll kind of break this down into two parts, right? So first you have, is this work R&D? And it's
Yeah.
subjected to a four-part test. Real quick, are they doing something new or improved? Right? They might have an existing thing and they're just improving it. It has to be something that is an improvement or new. It's pertaining to functionality, reliability, quality. These, or durability is another good example. These are measurable, right? You can't just say, now I have something a different color and the consumers like color. That's not a measurable improvement. We're trying to live in the field of repeatable sciences, right? And then the second part is, hey, is there a technical uncertainty? Are you unsure about how you're going to get there? How you design this? What's the method? What's the capability of even doing this? And then the third part says, what's your process of experimentation? Essentially, how are you figuring out that uncertainty to do whatever you're trying to do, whether it's process, product, or both, or a little of this, a little of that, maybe in different departments. And the last part of the test says, is it technological in nature? It's just lawyers speak for, is it rooted in hard sciences? That kind of goes back to my original point, where is it repeatable? Is it something that they can do over and over again, such that their R&D led to this result? And so once you have qualification, then you say, great, who was involved? What was involved in that activity qualifies. And there's really four categories of expenses here. First is labor, employee wages, right? It's going to be those that are directly doing the work. It's going to be those that are directly overseeing the work, and those are directly supporting the work. There's a great example of the Treasury regulations give where they talk about essentially a chemist in a laboratory, right? This is classic R&D. Doing some complicated experiment, and you have that chemist doing that work. But you also the lab assistant taking notes, cleaning the beakers, and then maybe you have a professor, right, overseeing, making sure they're following guidelines, making sure they're doing things in accordance with the parameters that they collaborated on. The experiment's complete, it fails, it doesn't matter. Point being is every party that I just listed is essential to the product development cycle. We can't say, well, who's
Nice.
cleaning the laboratory, right? It's too far removed from the person doing the R&D, in that case, the
Yeah.
chemist. But we call that the one up, one down rule, right? One up from the individuals directly doing it, kind of hands-on R&D, and then one that's strictly supporting it. One
And
down
that's
from
kind of
the
how you have like a strategy that's defensible for your tax strategy is repeatable. Because I kind of think of like, yeah, like moving down the supply chain to manufacturing. It's like, I'm just thinking of like extraction techniques. It's like it has changed drastically from like super early days using butane. It was unsafe into like
Yep.
full now different extraction techniques. But even once they have one, like then it's like increasing the yield. And so there is like this continuous improvement that's going on that's like takes a little bit of R&D where it's like, okay, that didn't work. Let's do this. And then you can actually like see the average yield go up over time of like, all right, if
Yep.
we run 100 pounds, we're going to get this much oil out of it. And so that seems, and then to your point, there's like the person running the machine. It's usually like people supporting it. Then there's
Yep.
usually some type of management above it where it's like, yeah, this time spent is purely on trying to like improve our processes, which is development.
Absolutely.
Okay,
And then
sweet.
so you have that group, you have that subset of your team, what have you. What's excluded, right, is going to be maintenance work, we'll call it administration, marketing. Look, they're critical to business. We know this as an attorney and CPA, but we don't qualify for R&D. We're not doing the
Yeah.
R&D work. But to that end, when you can identify the amount of R&D going on, then you're figuring out how many people are involved. Great. Let's kind of allocate a portion of their time. Hey, I spend about half my time on R&D, new prototype development, and the other, the personnel management. We also have our commercial products that are tried and true. We sell to keep the lights on, so we can even explore this R&D program, right? So that half and half split, taking 50% of their wage toward R&D expenses. It's just one person. You can kind of see how it's all spread out, a little there from the
Yep. Yep.
supervisor, a little bit, maybe there's more people on different projects depending on scale. Then you have your testers, we'll call them. All those expenses and the wage level get aggregated into one bucket. And that bucket of expenses is your, hey, here's my total qualified R&D spend. Portion of that is going to yield somewhere between typically 10 or 20%. So $1 million in R&D spend, it's not unreasonable to think I have $100,000 to $200,000 in R&D tax credits, all things being equal. And so not to monologue too much further, but the other categories of
Yeah,
costs,
yeah,
outside contractors, they can qualify. Testing labs, right? Hey, they aren't W-2 employees, part of your development site, but you need side testing to actually see
yeah,
this R&D project too. So you can capture them as well, so long as they're US based. Another category of cost is raw materials. This is where it gets a little fun and tricky in this space because you think so much of what I buy is for that, and that may be true. But the caveat here is kind of twofold. One, you can never take real property as an R&D cost. You can't take the cost of the facility. It's something you're already depreciating.
like
Um,
a piece of equipment. You can't be like, yeah, we bought that equipment to see if it would be a better extraction piece of equipment. It's like, no, that's a equipment. Okay, that
yeah,
makes
and you're going to
sense.
depreciate it. One thinks, and so you can't double dip on it. I'm going to depreciate it and then simultaneously take it as a qualified expense. It's a little flies in the face of that.
Okay.
But if I purchase, a bulk of,
What about
say,
an
material,
attachment? So like we have like a trimming machine and now there's like this new AI component that's supposed to like track the
sure,
buds better. What about
sure.
that?
Yeah, maybe there's an argument to be made that we can tie that to process improvements such that, they couldn't ultimately, get to that end result.
But we
But
couldn't
that's kind of,
depreciate it as well. Okay, that makes sense. So you can't double dip. So it kind of lends itself to like smaller improvements because like anything over 5 or 50K, depending on how big the company is, we're gonna put on the balance sheet as an asset versus just expense it. Okay.
Mhm. But you do get the aspect of this where if you purchase, hey, we need to develop this new product and we purchase a ton of material to kind of run it through and test it.
Yeah.
All of that, it's all consumable material. It's one and done usage, right? You can't depreciate it. It doesn't have a shelf life longer than a year, so it can't be
It's
depreciated.
like the gummy that's like licked in. It's like that was like a funny expense. I was like, dang, I've never had to buy this much amount of like gummy
Just,
material. It's like, oh, well, you're just
but
kind
that's
of
what's
developing
needed.
it. So I'm like, okay.
Exactly. So consumable, I don't know. I don't want to conflate the term consumable in this case, but we say consumable in the context of kind of accounting and R&D. We're saying essentially something as a one-off usage, right? It's going to get destroyed after I use it because I'm
Yep.
testing with it, right? And so those costs can compound dramatically depending on how much you're buying to figure out the thing you're doing or figure out all the things plural you're doing. Companies have multiple R&D projects in a given year, and they don't even realize it. So there can be a plethora of R&D costs that fall into that category.
So a question that I can see coming up is like cannabis companies, because it is a small startup industry, and it's like for better or for worse, like all these companies, like in my preference, like they're all small to medium sized businesses. Like they're usually less than 100 million, candidly, usually less than 20 million, a lot of them. Like
Yeah,
outside of the pubcos and the MSOs, like by sheer
sure.
numbers, the sheer amount of like the majority of cannabis companies are fairly small. So I guess do you have like an ideal like size of cannabis companies? Most business owners be like, ah, I'm too small for R&D tax credits, but like do you have a size of like either size of sales or employees where you're like, hey, you should actually start looking at your expenses for R&D credits?
Yeah, I mean, look, gosh, this answer is a funny one because the R&D tax credit isn't called the R&D tax credit in the tax code. Section 41 of the tax code reads as the credit for increasing research activities. It's a permanent part of the tax code as of 2015. So with that in mind, it's essentially asking, hey, are you doing this kind of work? Do you qualify? Great. And if you're increasing that investment, if you will, then year over year, you can increase that credit. So I've worked with very small companies, whether they're cannabis or not, and maybe they get a $10,000 credit. That company, it's a bit of a lifeline for them because that $10,000 now allows them to maybe purchase that piece of equipment that they want to explore that new process with, right? But then the next year, now that they implemented that, now suddenly they're growing, they're scaling, the credit is going to increase because now we're investing more and more. And so I've worked with companies who've started small and now they're really big. And we have been on that,
Nice.
train with them. So I don't ever think I have a small amount or a minimal amount because I view this as a partnership. And since R&D credits are permanent, you want to be with them along the way.
And you can get it every year. Like as long as you're doing research and development every year, which like it's a young industry. We're going to be doing R&D for a long time, I
Month.
feel like.
Yeah.
Okay, yeah, you can get it every year. And especially
Yeah.
the states that have decoupled. And then that brings me to the federal question, kind of like we were talking off air. Like Obviously, everybody heard the executive order to make Schedule 3 happen. Timeline till still TBD. So without pontificating too much on the when
Sure.
it happens, but like if it does happen, how does that affect the R&D tax credit just at a high level? And I know you're
Oh
on the
man.
legal side, so I guess like can you give us some your thoughts on like timing and effects?
Yeah, I think, I mean, not just in R&D, but there's tons of tax incentives out there and tax benefits that regular commercial companies take advantage of, right?
Yeah,
That
yeah,
these
non-cannabis.
companies don't get the option to. So I think, I don't want to say you'd see a gold rush, but it's certainly perked the ears of people who don't dabble in this space because it's inherently complex. It's a little bit of a minefield when it comes to federal and decoupling and all the fun stuff that comes with that. So, if that were to be the case, where essentially we're talking about federal legalization, then that's going to open up the door dramatically for what I would expect significant growth in this space and significant investment. And I think you kind of saw that about 5 years ago, with the seemingly the posture was going that way. And you saw all this
Yeah.
capital go and all kind of betting on it, time ticks, and then that sentiment fades and then it's tough. So you do what you can to stay alive. If this flips and we see it federalized, then I think that every single cannabis company should explore this opportunity, whether you're a 10-person cultivator all the way through MSO with top line between 50 to 100 to 150 million, even publicly traded companies were seeking to IPO even.
Yep.
So it's
Yep.
it's lucrative. Yeah.
No, that is interesting because obviously, like, yeah, like you talk to a lot of non-cannabis business owners, investors, and so somewhere on the CPA side, it's like well, I did a lot of this before cannabis, and so these like there's this whole world of like capital and professionals and business owners outside of cannabis, rightfully so. It's federally illegal, so like
Yep.
most people who don't care about cannabis don't care about cannabis, and like
Correct.
because we live in this world, we think everybody's worried about legalizing and like oh another state has gone adult use, and it's like most business owners and like market makers like they're busy with much bigger industries with much bigger companies and so yeah I think this like murmuring around schedule 3 at a minimum it creates positive incentive sentiment and like is a good news and yeah once it becomes more of like some type of federal framework around it it does like open the doors up to a lot more interesting players entering the space which is just going to be part of the continued evolution of the cannabis industry.
Yeah. I think you'll start seeing some horizontal, I don't say horizontal integration, but you'll start seeing independent processing companies, right? We're not going to cultivate, we're just the processors. We're the best at it. We have the best processing process you can think of. And then we have the best cultivators. They don't have dispensary, right? They're not downstream all the way. I think you'll start seeing that kind of happen within the thought economic landscape there. And then also in this space, I always like to think about it as well as you have plant touching companies and non-plant touching companies, right?
Yep.
There's a host of cannabis servicing companies. You and I are really no different in this case, right? But think about a company that develops software for dispensaries that's for their point of sale systems, right? Companies that are developing software that integrates with Metric and is easier to use than Metric. Think about a manufacturing company or engineering company that develops pre-roll machines, architects who develop greenhouses, right? Those companies are all doing R&D. They're not trafficking in cannabis. They're not non-plant touching. They don't have anything to do. They're just doing architecture. They're just doing software. These are naturally R&D based activities, especially for a new field, new sector, if you will. And because they kind of they find themselves dabbling in there, if you will, I often feel like even those companies overlook the fact that they should be taking advantage of this federal level because they don't Schedule 3 or 280 doesn't apply to them. They don't they're not trafficking in anything. Trafficking means to move and to sell. What are they selling? They're selling software. They're selling the architectural design. They're selling the machine the cultivators use. They're traffic.
Right, right. So we do accounting, and I'm like trying to think about like what if we do anything that's like R&D related, and
Sure.
look into that.
Let's see your
But I
wheels
guess like
turning.
yeah,
Yeah.
because I guess for some of these cannabis companies, because like yeah, we're exiting 2025. The tax season is upon us. All the CPAs are gearing up for another tax season. But
I'm with you.
yep, yeah, but 2026 is like a new year, and so as we know, it's like it's way easier to have a tax strategy that's defensible and works if you try to focus on it every month, every quarter. You do that, then you build out a whole year. So I guess what should business owners be either doing or tracking or thinking about monthly for to make sure that they can take advantage of this R&D credit either at the state or federal level?
Yeah, I mean, I've told many business owners this is they don't necessarily let this tax incentive kind of guide you so much that you're ignoring the core operation of your business. However, if you can incorporate some tracking mechanism where you say, every time you're developing a new strain, you're calling it out. This is the first iteration and we're doing this. It's a way to start bringing documentation into that sphere of R&D where you say, look, this is the first time we've ever done this. Or, hey, we have some new initiative, document that in some form. I don't care if it's a Word document. I don't care if it's an email, but make some cognizant effort to call out the fact that we're doing something new. We're trying to achieve something that is effectively a risk, right? We don't know if we can pull this off. We don't know if the marketplace is going to like it. Those questions, if they're percolating in a business owner's head, naturally lends itself to R&D. Because when it comes to not just R&D, but really any tax incentive, specifically, you can look at Section 6001. There's no specific documentation for any tax credit
Okay.
incentive, really.
Just kind of
Barring
quantify
a
it
few.
somehow with the expenses. All
Yeah,
right.
but do you have something? It shows me because 10-person company isn't going to have detailed time tracking. Yeah, other things they're focused on.
Yeah, yeah, it's gonna be
Uh,
like payroll. We would have to do like payroll by room. It'd be like, all right, there's
yeah,
this much payroll, there's 10 rooms and two of them are R&D rooms. So 20% of the payroll and kind of back into that. Is that kind of what we could do?
a little bit of that, or I'll say,
Not to
well,
oversimplify it. I don't want to steal your
no,
mojo,
no,
Kevin,
you're
but
good.
I
I
like
like that
that.
you said that because there are cultivators who are like they go, yeah, I have two R&D rooms where all we do is prototype in those rooms, and I'll go, well, who's in there the most, right? And so to your point, you're saying, oh, well, 20% of payroll is going to go to that. Not necessarily true because I might have my two kind of nerd in the jar, people who really spearhead this, and they live in that
Yeah,
prototype
yeah,
room.
that's all they do.
So
Okay.
all their payroll is their particular payroll should be not 20%. They should be much higher.
It
But
would
then
be
maybe a few
100%.
testers that are 20% because they're just touching the testing, getting in there and kind of beginning life cycle to end. So you
That makes
carve out,
sense.
yeah,
Okay, because we do something similar for the cost accounting for, yeah, just like kind of address 280E. It's like we're trying to get as much cost into product manufacturing or development or product manufacturing as possible. It's essentially like get them into inventory and then recognize them as COGS. And so it's like as long as they're related to like product manufacturing, that's going to go into COGS. So you kind
yes,
of got to like break it out of like this person's this much percentage, this one's zero because it's like a sales guy.
exactly. Similar, very similar, right? Where it's like, oh, well, this person, hey, they're marketing. They're 0%. Their salary should not touch this. But head cultivator in their 6 years, person's probably going to have a chunk, if not all of their time attributable to R&D. So that's always kind
Okay.
of key for them to note.
Or even like the products guy, because I feel like there's this other gentleman where it's like all he does is product innovations, and it's like trying to think of new ways to make vape tech better. And it's like, all right, well, that would be like all his whole team is all new product dev. All
That's the
right,
sub team. Yeah.
I see we're kind of coming up at the end of the hour here, so I guess just kind of
Yeah.
look into the future a little bit, Kevin. I want to always like kind of end on a positive note, but what are your thoughts about the future and kind of 2026? What has you excited about the industry and kind of what are you looking forward to in the new year?
Yeah. I mean, twofold. One, I think us at Royce Partners have really understand on this. And I think you saw that at MJ when I was on the panel there. We're saying, look, these tax strategies are not risky. These are something that are completely defensible. We're not flying off the handle here. And I'm really excited for that education to naturally percolate across the industry and we go, wait, I can free up capital here. That allows me to do this over there. And there's
Yeah.
providers in the space who specialize in this. So very excited for that to kind of pick up because what I've also witnessed, and I'm sure you have as well, is a lot of these companies have tried to stay above water. There's a lot of M&A action that's happened over the past couple of years, just given cash flow constraints. And as a result, we're seeing a lot of consolidation, and that's usually because these companies are kind of forced with a choice, right?
Yeah,
But
yeah, for sure.
if we can be strategic and help these companies free up and any capital where they can, that may be a lifeline where they can live another year, such that maybe 280E goes away and they're back in full business mode, and that's great for them. So I'm excited for that. And then honestly, when it comes to just the legal landscape itself, and this is actually a benefit to lawyers in general, right? It, it's, for lack of a better term, it sucks for predictability of the markets, but when you think about all of the conflicting information going on, right? You have Biden doing an initial executive order. Now you have this current one in place. Then you had some rescheduling, kind of some comments here and there. You have the health HHS coming down saying, actually, this isn't as addictive as we thought, shouldn't follow Schedule 1. There's a lot of conflicting information and narratives such that one can make the argument where, do you guys know what are you guys sticking to here? Does the IRS know what they're actually kind of having to deal with here? Because to create all this confusion really means we have to create uniformity. And uniformity means, can we get this rule in place, or can we legislate it through? As I mentioned at the beginning of, let's get this cleared up. Let's get this through. I hope it's the case, but the core of the job for me is help these businesses survive any way I can, get them lucrative tax credits that they're entitled to, put them in the best tax position possible within reason, of course, and it's defensible, and help them navigate a very complex land field or landmines, I should say, and really put them in the best position possible. It's what we see ourselves doing and continue to do.
No, that makes a lot of sense. And it's everybody always used to get so stressed out about somebody like a Royce Partners, like, oh, these outside consultants don't
Sure.
understand the cannabis industry. And it's like, no, man, like we understand tax code and like you're still a company in the United States falling under the United States or, state and local tax codes. Like I know where to go to read what's right and what's wrong. Because people do
Absolutely.
kind of like very quickly like do dismiss R&D credits. They're like, no, it's not allowed because I'm a cannabis business owner. It's like it's worth taking a second look. And like I was saying before this, it's like as the dope CFO, it's right in the name. Like I was a CPA, and so like when I see two CPAs on stage kind of disagreeing at some of these ones, which is fine. It's a young
Yeah.
industry. Like we're growing and that's kind of what makes
Yeah.
it fun. And it's like, and same with like tax attorneys, like they kind of disagree a little bit. It's like, okay, there's enough of a gray area where as long as we have really good books and records, we tell the government what we're doing and we say, hey, we're taking this code because we think you guys are kind of unsure. And my teammate Daniel, he was an IRS agent for 6 years. And so he's got some of
Mhm.
the funniest stories about like the inside of the IRS agency. And like,
Yeah.
yeah, they're not as buttoned up as everybody would think, and they all know what they're doing. It's like 80, like tens of thousands of people work at that agency, and they're all trying to figure out this new state by state tax code. So
Yeah.
yeah, so it's like don't try to figure it out yourself. Go to somebody like a Kevin who works for the Royce Partners, where all they do is look at like complex tax codes for unique industries and highly regulated growing stuff. Because even our founder Andrew, like he came from oil and gas, where there was like
Mhm.
tons of like unique tax codes and things were changing. It was
Tons.
highly regulated and it was capital
Rules. Yeah.
intensive.
Yeah,
So
it's I could not agree with that sentiment more. And how we're structured too, not to do a shameless plug here
hey,
is look,
shameless
I know,
plug, go away.
let's
It's my
do it.
podcast. Fire
Let's
away,
do it.
Kevin.
The shameless plug is look, on the front end is always a courtesy evaluation. It's let's look at what you're potentially sitting on, or are you sitting on anything at all when it comes to R&D tax credits? The answer is no. You got the knowledge and you didn't pay anything for it. Or if you're sitting on something, put it in front of you and you say, let's go after it, then we're going to go forward. But if you say, not high enough, not good enough, walk away, no cost. Because you don't know what you don't know. And that's what I mean by expanding the educational aspect of all of this is I want them to tell their friends in the cultivator space that it was something that was, it was 100,000, it was 10,000, whatever it may be, and let's spread that knowledge and put these companies in a much better position that they may not otherwise be in. And it's a shame that I see effective tax rates that they're dealing with because they have not their own livelihoods, but employees that their livelihoods depend on the revenue of that company. So the better position the company is being put in from a tax standpoint frees up capital, and that just opens up a better environment for that company itself.
No, for sure, for sure. And right now in the environment, surviving is thriving, and like
Well
having
said.
a good
Well
tax
said.
code, it's like you got to be a little aggressive. And to your point, it's like it's not even aggressive; it's just thorough in your tax
Yes,
strategy. It's
that's what
like
it
you
is.
kind of got to look at everything. But anyways, I could nerd out on this all day. I'll let you
You
get out of
too.
here, Kevin.
Oh, man.
Thanks so much for your time, and hopefully we'll cross paths here in 2026. You be
Oh,
well.
very much so. I think we will. It's a pleasure talking to you. Always appreciate this. And yeah, man, I'll talk to you soon. And then I wish you the best and we'll talk soon.
Yep, be well. Talk to you
Bye.
later. Bye
Bye.
bye.